I'm Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Steve Black, the co-portfolio manager of the Pengana Emerging Companies Fund. From a format perspective, Steve will keep his prepared section to around 25 minutes to half an hour, so we will have plenty of time for Q&A at the end. So please, any questions that you have about the fund or the investment environment or specific exposures, please enter them into the Q&A box that can be accessed from the icon on your screen, and hopefully we can have an interesting conversation at the end. Steve, pausing briefly on the disclaimer, I'm going to hand over to you.
Thanks everyone for joining. As a reminder of who we are, this was a fund that Ed and I commenced in 2004 with an underlying belief that there was a mispricing in small companies that came about due to these small caps not being well researched. So we started this fund, this journey, about 20 years ago now. It's been a successful period of time. We've invested in delivering a return of about 12% per annum, which is an excess return of about 7% above benchmark. Ed and I have drawn on around 60 years of combined experience, having been in and around small caps for the best part of 3 decades each. And it's very much a risk-based approach to investing, and there will be a chart on that I'll talk to in a moment. And it has served us well, very enduring process that has performed well through all investment cycles, and clearly there has been a lot of volatility over the last 20 years, GFC, COVID, etc. Performance has held up well through all those periods. And I think the other key point here is that there's that strong alignment of interest, which you would have heard of us talking to before. But as a reminder, so Ed and I own 25% each of the business, and also our investment in the small cap space comes exclusively through units in the fund as well. So the update, and this is the last 6 months for the fund. You can see there that it has been a good 6 months for us, delivering performance of 3.9% after fees, up against the Small Ordinaries Index of -2.5% and the Small Industrials at 0.4%. And the winners, the losers, there's always a lot of volatility at our end of the market. And then in terms of the portfolio itself, our cadence continues at around 200 company visits per annum. That's where we get our idea generation from for the stock, obviously, that we buy for the portfolio. It's about a 60 stock portfolio. And I probably should add also that it's a short period of time, the 6 months, clearly, but the importance of this 6 months, we always have a very strong eye on the performance around reporting season. So we had a very strong August and September in terms of results. And we'd like to think that comes about because we've held the right companies that have delivered great results through reporting season. So share prices are moving around on facts and substance rather than just fads or sentiment that's running through the market that's pushing share prices around. So if we stand back from the shorter term and look at the longer term history, it has been a highly successful period of performance over that, as I said, that nearly 20 years now. The power of compounding of alpha is in evidence there on that top chart, with $100,000 invested at the start of November 1, 2004, today being worth $810,000, assuming reinvestment of distributions, up against what an ETF would have delivered you in terms of indexing your investment of about $220,000. I think pleasingly, the consistency of those outcomes over that period of time is something that we're really happy about, if you like, in terms of the period of outperformance is not in one period, it's overall periods, overall timeframes, and has tended to average around that 7% per annum mark. So we look at the composition of the portfolio. We have keep a very strong eye on the risk. It goes without saying that in small company investing, when things go wrong, they can go very wrong. So we firmly believe that the risk of a portfolio is most definitely at the stock level. And you saw even from the chart at the start, just the volatility in a short 6-month period in terms of the stocks that perform well and the stocks that did perform well. This end of the market is very volatile. So you do need a true stock technician to forensically almost work through the risks of investing in these companies. It's more than just focusing on the upside of the returns. It's about the risks that you bear. So these are some of the, I guess, some of the factors we consider to help mitigate the risks, to allow for that bottom-up risk at a company level. All our valuations are driven by cash flow. We don't buy stocks for the portfolio on any other consideration, any other valuation tool. Cash just simply doesn't lie. A clever accountant can manipulate or heavily provision accounts to potentially over-exaggerate profits. So we steer clear of profit and focus on cash. Concept stocks are avoided. So we're far less interested in a company with an idea. With a charismatic CEO, we're far more excited about a company that has a proven product in the market that's being commercialized, that's, as I said, delivering real cash flow. Therefore, we have confidence in our valuation approach. Overly complex business models, they most definitely heighten the risk. If we can't wrap our arms around how the business ticks, what makes it work, how they deliver their competitive advantage and longevity in terms of earnings growth, then we'll typically move on. We are in that fortunate position to be spoilt for choice. We're looking to build a 60 stock portfolio from what we estimate to be about 1,000 companies that we have to consider for our as our investable universe. So we just simply do not need to buy or own companies where we don't feel we fully understand the business model. Not owning mining stocks, which you would be aware, certainly reduces the risk of the portfolio. They are largely, particularly the small end of the market, are largely loss-making companies, exploration companies, where results will be more driven by exploration outcomes or commodity price movements. It's not an area that we have a strong belief in terms of the durability of those returns long term. Over-earning's not always obvious. It's probably pertinent, particularly coming out of COVID. There's been a lot of companies we've seen that have probably had their profits fattened up a little bit during COVID, and they're still running off some of that high end of, in terms of margins in particular, that higher profitability. So we just need to be mindful of that coming into a period where COVID's largely a non-event, obviously, in terms of expenses and revenue for companies. And IPOs are always dangerous. You've heard us talk about that many times before. Particularly with that over-earning characteristics. There's been some companies already have come to market, I think, from promoters and insiders trying to perhaps game or benefit from a market that perhaps doesn't fully understand the degree to which they did benefit from COVID. And balance sheet, always a topic, but more prevalent and pertinent now, given the cost of finance that a lot of companies now obviously have with debt, will have a higher interest burden in their P&L statement. So this slide here, and it's a busy slide, I won't dwell on it too much, but suffice to say that over the 20 years, coming into 20 years now, we've had a lot of hits and a lot of losses. We're still learning. There's a lot of companies that have not performed as we would have liked, and we learn from those mistakes. After 30 years, we're still improving our approach to investing, we believe. But the upside there, you can see there that the best buy ideas, some of the stocks we've owned have delivered incredible outcomes for our unit holders over that period of time. M2 Telecommunications, set up by a very clever telecommunications entrepreneur in Vaughan Bowen. We backed him very early on, soon after we started the fund. That was a 5-bagger for the fund. He then moved to another company called Unity Wireless at the bottom there of that page, and it's delivered similarly very well for us. That's in the broadband space. So it's an example of where we do like to follow quality management to other companies, to at least pick up the phone, have a meeting, and see what they're up to, because that often can deliver positive outcomes. And then realestate.com, I'll call that out only because it was a stock we'd followed way back in the days before it was even profit making. Obviously, it wasn't investment grade for us because it wasn't delivering cash, but it does highlight the need to keep close to these companies because things do change quickly. So When it became profitable, we took a small position. It was still too illiquid for us to take a meaningful position. And then we had the phone call that Ray White Real Estate were looking to sell out at $7.50, and that gave us the opportunity to build up a meaningful position. The stock did incredibly well for us. I hasten to add, we didn't sell it. We still don't own it now. It's too big a company, but we did sell it at around that $70, $75 mark. And then in terms of the worst ideas, I mean, there's some themes here that probably worth mentioning, the roll-up story. So Blue Freeway, which is BLU, or Photon PGA, just highlights that the risks of investing in any company that has an inorganic growth strategy. They were small acquisitions, but they weren't integrated correctly. It was a very tiny weight in the portfolio, but they all hurt. Access Today, ThinkSmart, are two finance companies operating principally in the SME and the retail space. And probably the lesson there is that no matter how much work you do in these companies, you don't fully comprehend the quality of the debt book that they've written. And that's and both those stocks fell foul of that problem. And I think it's coming into this time now with a slowing economy that increasingly becomes a risk. So just moving quickly over to markets, and this is just really a reality check, if you like, that we all hear about the doom and gloom in markets in terms of China and inflation and now Middle East, but it is a little happy reminder that those media stories that are sensationalized and magnified by social media, in the long term, they don't mean a lot to performance outcomes. That it also ignores the fact that markets look forward 12 to 18 months. So trying to time your entry with regards to the potentially falling for the emotional side of investing through what you read in the press or hear online is really not the point. I think it misses the point. In a 10 to 30-year investment time horizon, the trend is certainly a friend in terms of the risk asset classes like Australian equities. And probably another misnomer is the small cap versus large cap topic. The small cap effect, is it real? Is it not? The chart here would suggest it has been very difficult for small caps versus large caps. So that chart highlights the bottom there. The blackened line is the broader market, and then the small ordinaries is the grey below. So it's obviously underperformed. But the point it misses is this is not a beta capability. It's the alpha opportunities that come from investing in their spaces, which is why investors choose small caps or small cap fund managers, because they have the ability to deliver alpha that's not available in the larger caps because of that mispricing event I spoke about at the start. And I think some of the reasons I highlight there as to why there has been this outperformance are listed there, but passive investing, where there's really there's no intrinsic reason for it, but just flood of money or momentum investing has driven a lot of money into the more liquid end of the market, which is obviously going to be the large caps. So that's driven those up higher. And in the shorter term, and I'm not an economist, I'm not going to pick short-term market directions. We are always fully invested in the fund for that very reason. But this shows in more recent times how small ordinaries have underperformed the larger companies. I think that risk-off mentality, when people get spooked, they tend to take money away from the less liquid part of the market. And the point here is markets are forward-looking. It's interesting that we have a lot of history in Australia, but in America, in the last 6 US recessions dating back to 1980, on every single occasion at the bottom of the market, this is the shape of the curves in terms of large caps versus small caps. So when risk comes back on, they tend to perform very, very well. So market observations, some of this will be very obvious to you, but the reporting season having just concluded was probably better than what a lot of people expected. I think that after 11 interest rate rises and a little bit of negativity out there in the market, particularly as it relates to cost of living, that we would expect there to be a drop-off or a response in terms of revenue falls. However, that didn't transpire. So revenue held up very well for companies that reported. The problem was margins. So the cost pressures, labour, rent, energy, technology, really did pinch operating margins, and that will obviously accentuate into this current year. So we are very focused on companies which have higher pricing power that can negate that cost increase that will continue to flow into this year. The funding costs were a surprise. So it probably shouldn't have been when it was pretty obvious interest rates have risen, but the market did underestimate the extent to which that would flow through to a company's P&L statement. Healthcare companies were disappointed. They are a classic example of a price taker in this market, which is simply what you do not want to invest in. So a lot of their revenue comes from the government, and they're not that charitable. So with cost increases coming through, the increases in revenue, price rises that the government are putting through in terms of paying these healthcare providers hasn't kept up the cost of doing business. So they've seen margins squeezed. And we did act on that about 6-12 months ago and did reduce our weighting to that space. And just finally, the evidence we're receiving from the companies we're talking to, you would expect us to continue to, through reporting season, ask about into the current period, so July, August, September, as to how they're behaving regarding price. Now, almost without exception, companies are stating across the board that they will increase prices, not necessarily even just to counter cost increases, just because there's a broad acceptance out there that inflation's here and they can increase prices. So it's a very difficult scenario with that playing out to see how, with a mindset of price increases and acceptance of price increases, less pushback from the customers, that inflation is going to be reined in anytime soon to that sort of aspirational 2 to 3% from the Reserve Bank. So what does all that mean? Well, in terms of the portfolio positioning, the cash is always minimal. We're not going to time markets. We'll leave that to the asset allocators like yourselves. The attributes of the companies that we like to own, with low debt into the unknowns of next year, that's very, very important, and the cost of that debt. Earnings volatility should be low. Ability to preserve profit margins into an increasing cost environment is clearly incredibly important. Retail's a sector. We're getting closer. Some of these retail sector stocks, especially retailers, have underperformed dramatically. We still think they've got a fair way to fall, though. In some instances, they're still trading at near record share prices, despite the fact that profit margins are probably a little too high and need to normalise. And then the IT exposure we do have is in profitable IT companies. And I will hasten to add that those GICS codes, so the top part of this slide, which is set up by the ASX, is quite misleading in terms of how we're positioned relative to index. So, for instance, the financials include insurance brokers and health insurers, they're not true financials as you may, or how we would categorise them. So we prefer to look at the pie chart at the bottom there. The defensive part of the portfolio continues to be strong in over half the portfolio. So think about those as stocks that their prospects aren't necessarily reliant on the state of the economy. With strong management, they can continue to grow regardless of an economic downturn or not next year. And then, as I said, the cyclicals, financials are all relatively small technologies in the profitable end of the market. So this looks at now some of the recent changes in the portfolio. I won't labour the point, but it's always plenty of activity out into the market. The additions of the new logos into the fund, the sales of those that have exited totally, and then the increases and reductions of those that we own and like more than we did, bought more, and reductions of those that obviously we still own but have less of. So what I've got now is, as we typically tend to do, is we have a few stock stories at the end of the presentation. And I tend to focus in the past on the larger weights in the portfolio, which are probably in some instances already known to you. So what I've done this time, I've presented some stocks here that I don't think are that well known. So they're stocks that are generally smaller weights in the portfolio. They might be less liquid, they're not as large companies as the top end of the portfolio where there's more liquidity. But most importantly, they're not well researched. So almost across the board here with these 4 stocks I will profile, there'd be lucky to be one analyst covering each of these stocks. And that's obviously that's what excites us, because that's why we believe there's been a mispricing in these companies. So Gentrack is a billing software company for utilities and airports through the UK and Australia. We've kept a very close eye on this company since it listed. And in fact, we're almost guided or help assisted management at the time of listing. It ran pretty hard. We didn't buy into the stock at the start, but then it lost its way, kept close to management, and saw the opportunity to buy in there where that green dot is there. So just below $2 and about a year and a half ago. And then it's continued to do very, very well, obviously, since then. But we still see strong upside for this company. Because it lost its way, it underinvested in its product and its profit margins halved. So it generates profit margins of about 13%. They should be up around 25% for a software company of its kind. And also there's strong top line growth coming through as utilities, particularly in the UK, need to modernise their IT stack. And groups like Gentrack are certainly well positioned up against Oracle and SAP. It's been more nimble to provide that sort of customized software requirement. So trading on, it's probably P of close to 14 to 15 on our modelling now, is very cheap for a high quality recurring revenue business like this. SmartPay, another stock that you can see there that was languishing for a long time as it was loss making. We're not going to predict when a company's about to turn from losses to profits. We'll wait for it to be achieved. And then they gave us the opportunity to buy the stock, notwithstanding the fact that it already bounced very hard. But as I say, those risks had fallen away. So it's an FPOS terminals business. In New Zealand, they rent the terminals. In Australia, they rent the terminals, but also they receive the surcharge from their customers that tap and go on the terminals. Predominantly, it's been a bank-owned market with about 85%. SmartPay had 4% of the market last year, 6% of the market this year. So you can see the speed of growth in the marketplace, and they have a product offering that's far more nimble. Reporting tools have a lot more functionality, or have a lot more data analytics for their customers, and so winning strong share in the market. Cossal is a company where we bought into the IPO, the green dot there, and it's done very well. Think of Cossal as it was a good example of a company where we have back management that have performed well for us in the past. So Jeff Lewis was the CEO of ASG Group, which is a company we owned a good 5 or 6 years ago. Did incredibly well there. Jeff put the band back together. He came and saw us and got this idea. It's almost like a compliance listing here. We don't need much capital, but we're wanting to list for the right reasons. We want to raise money, buy a few more tech companies, and offer more products to our existing customers. So it's a business that's in the software that manages critical assets for companies. So it's a very integrated software solution for companies. So you generally don't see churn, you don't see customer loss, and as you can see there, it's growing organically at about 15% per annum. But their customers are like the Defence Force, large mining companies that need to optimize their expensive assets. And Crystal Corporation is a company that, as you see, we again bought into the IPO. So it's we tend to be very skeptical, and with companies into IPOs, we're very rarely do we buy them. But they were very small positions we took at the time. Now this one didn't work for us, and it fell badly, despite the fact that the share price, but the company actually outperformed its expectations in the result. But that let us gave us opportunity to buy more stock at around the $3 level. So what Crystal does is it's in the assay testing space. So there's a more typical fire assay testing, which has been the sort of the go-to approach for the last few decades, where gold explorers will take samples and then test those samples for gold content. And you can see there that the new approach, the photon assay approach, which has been developed in conjunction with the CSIRO, it's far more efficient, it's quicker, less hazardous wastes, cheaper, it's automated. and that's led to that units being contracted on the left side there of the chart, on the chart there, and it's now has about 7% of the global market. So finally, before I open to Q&A, so this is the top holdings of the fund. The size of the icon does matter. It's representative of the size of the position in the fund, but probably the consistent message across all of these is not only do they have strong upside in terms of what we think they're worth in a DCF-based valuation sense, but also we have a very strong hold on the risks of investing in each of these companies, and they have reasonable levels of debt, and they have good pricing power into next year with regards to inflation continuing to increase through the economy. So with that, Adam, I will pass over to you for any Q&A. Thank you.
Great. Thanks, Steve. That was, as always, a very comprehensive overview. We have received a few questions already, so I'll start with those. But just a reminder that if you do have questions, please enter them into the Q&A box. So the first question is, I think, an excellent one. You made a point that over-earning isn't always obvious. Are you concerned that any companies in your portfolio could be over-earning at the moment?
Well, it's certainly something we, as you would expect, we keep a very close eye on. If I think about the stocks that we have transacted in the last 6 months, then there would a stock that I will call out would be Metcash. So Metcash would be, and we've reduced Metcash. We still own it, but about half the weight that we had 5-6 months ago. And that was principally because they, as the principal wholesaler to IGA have benefited enormously from sort of local shopping, so away from the big supermarkets, which tend to be in the hubs of major cities and towns. So the IGAs are more your corner store, so convenience shopping. So as people have been returning more to the office and to work, and also probably a little more focused on price, Metcash has seen a little bit of market share loss, which is what we expected, and so we accordingly reduced our weighting there. Another example would be Australian Clinical Labs. So it's a pathology business, obviously benefited enormously from the COVID testing that was occurring. And in our modelling, we've obviously stripped out that testing revenue, but in even the most recent results, they were still generating some profit from COVID in the last 6 months. So that was something we had to allow for in our positioning in that stock. But as I said, that wasn't a surprise. We expected it, but it was technically over-earning in the result just released. But probably the main area of concern would be IPOs. So IPOs have the disadvantage that we haven't seen years and years of accounts registered and lodged with the ASX that have been audited under the regulatory requirements of the ASX. And there tends to be a lot of what we call normalisation of earnings through IPOs, through promoters, sponsors of IPOs tend to normalise earnings. Now that there's a fair amount of there can be some arbitrary allocations of costs, etc., with regards to that. So we would argue strongly that it's a heightened period of concern with regards to what is true earnings when you've had past earnings that have been influenced by particularly COVID.
And so by extension, your approach to investing in IPOs is?
We remain sceptical. We very rarely do invest in those. And if we do, we will allow for the risk that we bear, because there's simply unknowns that no matter how much work you do, you're not going to get total comfort on. We'll allow for that risk by keeping the weight in the fund very small. But we will never say no to an IPO. That we run with the philosophy that there's no meeting with management of any company that's a waste of time. So we'll always take a company meeting. It gets us, gives us an understanding from a competitive standpoint or a supplier standpoint of a particular industry for perhaps some of the companies we've already invested in or considering investing in. But moreover, it helps us build up a rapport with the management team for that particular IPO. Once it's listed for 12 months to 2 years, and some of those IPO risks have fallen away, they can be very good investment opportunities for us. So we like IPOs because they deepen the market and our opportunity set, but we also remain very wary of buying into them at time of listing.
I think your comment about never turning down a meeting leads well into a question here around the team structure. So maybe you can just talk a little bit about the structure of the team and why lean for you guys works best.
Sure. So the team is Ed and I. It has been for 20 years now. It's we firmly believe that the dynamic that we have that's delivered the outcomes that we've seen over the last 20 years, and as I say, it's been tested through a lot of investment cycles and even the approach and philosophies that we adopt, tested obviously also from my time when I ran the Goldman Sachs JB Weir Fund for 8 years, delivered similarly really good outcomes. But our fundamental view is that Ed and I we can cover all the companies we need to cover in terms of identifying investment opportunities for the fund together, because it is a bit of a needle in a haystack, but Ed and I will meet these companies together. We're very quick in our thinking. We will make very quick decisions as to whether we think it's a company that we will fully model up with discounted cash flow, balance sheet, P&L, use an opportunity to go back to CFO, prove up the thesis. But more likely than not, we have an hour with a company, we decide for whatever reason, drawing on our experience, that its share price has captured the upside. It's not something we necessarily want to consider for investment, in which case we drop the file. So we have an exhaustive company visitation program. As I said, we've since the get-go, we've averaged almost one company meeting a day. So we're seeing the companies that we need to see. It's that ability for Ed and I, that dynamic of us understanding what moves share prices and how to value companies, that I think is at risk if we introduce other fund managers or analysts to the team. And nor do we need to or think that we've got the time to manage those people. So we prefer to stay lean, keep the fund size small, recognise that where our strengths are, and it's not in mining and loss-making companies, we still have a very large number of companies to build a portfolio from, and to stick to, as I say, stick to our knitting, know what we're good at, and leave the rest behind. And that's there's no other fund that we choose stocks for, or we don't have a micro-cap fund. It's just a pure one pooled fund for all to invest in, and it's where 100% of our energy goes to.
Great. And that discussion of process has sort of led well into two other process questions. I'm going to ask them both at the same time, and you can sort of build your answer. So the first question is around effectively the funnel, narrowing down the list of potential stocks you buy into. And the second question is around sizing, how you trim positions, manage large positions, etc. The question here is around having meaningful insights into 60 positions.
Yeah, so you might be many people are surprised as to how large our investable universe is. Once you remove loss-making companies, you remove the mining companies, and you remove property trusts, because we don't invest in the bricks and mortar. They're a bit slow moving for us. We'll invest in businesses. That we still have almost 1,000 companies to build a 60 stock portfolio from. But the reason that is the case is that we can invest in mid-cap stocks, but most importantly, we can invest in companies down to as low as $50 million in size. So the benefit, and I think this is lost on potentially some fund managers, is the benefit of keeping the fund size relatively small and nimble. And many of you will be across the fact that we've soft closed on quite a few occasions over the journey, is to enable us to continue to explore at that low end of market cap range where you can really find some very exciting opportunities. So those, the next realestate.com or the next M2 Telecommunications. I mean, they're companies that did start when we invested in them at about a $50 million in size. M2 Telecommunications and Amcom, you may have heard of, and we were the first institutional shareholder in both those companies because we didn't have too much money under management, and we were able to take a position, albeit relatively small, but a position in those companies when they had market caps of only 50 to 100 million. When if you have too much money under management, you will have filters that would suggest that they're not investment grade because there's not enough liquidity there for you to even research them, let alone invest in them. So to stay pure as to and our label in terms of what we're setting out to achieve, when we set this fund up 20 years ago, we need to keep the fund a reasonable size so we can get on board early. With M2 Telecommunications, they raised money on several occasions, which for sensible purchases, which we happily contributed to, build up our position in the fund, and it did very well. Same with Unity Wireless is the same. So that's the reason why it's a large number of companies from which we look to pick a 60 stock portfolio from, and our filter is, apart from those exclusions I mentioned before, is really just at the meeting level. So we'll go out of our way not to present too many biases in terms of the companies we're wanting to research. Where a company will fail for us is at the point of meeting management. So we've had a lot of companies in our funds that standing and watching it on your computer screen you may think is pretty unexciting and boring and not worthy of consideration, but you meet management and you get a better understanding and grasp of the future of that company. So that's really the long and short of the need to keep the fund small. The filters are not that great, and then just seeing as many companies as we can as regularly as we can. That's where our true passion lies. In terms of the positioning of the portfolio, the sell discipline is really just the reverse of the buy discipline. So it's where Ed and I agree on the position, and then if a stock price rises and it's getting closer to our valuation, then that will be the reason to trim. Less upside, we'll recycle that money into a company that's not as well understood, and the share price is trading further below our valuation than the one that's share price is rising, and that's how it evolves. It's not particularly complex.
Great, thank you. And just to clarify for any prospective investors, the fund is open. There's plenty of capacity in the fund, so don't be frightened off by Steve's comments about keeping the fund small. The fund is open to new investors. Next question, and then I'm going to go into a couple of stock-specific questions. But you mentioned AI companies. Are you investing in any AI companies that you sort of specifically AI companies, companies that you expect to really benefit from this AI exposure? And are you concerned with any of those valuations?
So AI is interesting from the perspective that it's really captured the hearts and minds of investors globally, hasn't it? We in Australia, we don't have as direct an exposure to the AI. I was almost going to say bubble. I shouldn't fad, but it is. And then in Australia, probably the most of the exposure at the front end in terms of revenue opportunities is going to be driven by the data centers. So we like NextDC, for instance, Macquarie Telecom as well. We've looked at those companies. Well, the problem we have with those companies is they, particularly NextDC, they don't generate positive operating cash flow. So it's very hard for you from a valuation perspective to have confidence in what it is worth. And so accordingly, we'll look the other way. We'll look at companies where, as I said earlier, where cash is real and we have relative confidence. So where companies, and obviously this came out through reporting season, where companies are benefiting from AI or machine learning is through cost. So if you can have a machine that replaces an employee, then they tend to be a bit cheaper. So that is driving efficiency, cost savings, particularly for IT or highly sales focused companies. It's early days, but it is a topic in terms of hopefully margin enhancement rather than revenue generation in terms of the Australian small caps at this stage.
Great, thank you. Okay, so a couple of stop questions. What was your reason for selling Hansen Technologies?
We still own Hansen Technologies, just own less of it, and it purely came down to share price move. So its share price has risen, it's done well, and just moved a little bit closer to our valuation. So that led to that discipline to trim the position. It's certainly not a large trim, and it's still a very key position in the portfolio.
And your rationale for increasing the position in Praemium?
Well, Praemium, we've had a long successful exposure to the specialty platform space for many years now, and we still own Hub24 and Netwealth. But suffice to say that share prices performing like they have, our weighting to that sector is less than it had been. And you know, as is typically the case, these companies once they get discovered, they go into the index, they get more sell side and buy side analysts following them, and that's the journey from undiscovered to discovered, and the share prices will obviously therefore move upward, and they therefore led to smaller weights in our portfolio. Praemium, we feel, is still at that front end, so it's not a well-known company in the investment space, probably is in the advisor space, but it's a bit more of a specialist, a bit more of a niche specialist platform provider, or the high-end advisor or retail customer space. But it's with new management there now, there's a real focus and energy around product innovation, optimizing their costs. They've simplified the business. They got out of the UK, and it's a lot cheaper than Hub24 and Netwealth. So they don't have to do a whole lot right from these levels to perform. But at the end of the day, it just comes down to our valuation, and we see strong upside from these low share prices.
Great, thank you. Next question. Clear that you don't invest in REITs, but what is your approach to property sector companies like Goodman or Charter Hall, which are more about the business than the sector as such?
Yeah, correct. So Charter Hall we own. It's a smaller weight these days than it was a few years ago, when there was greater transparency and we had more confidence around that funds management space. Because Charter Hall, we look at as in effect just a property fund manager, and that sort of engine, if you were, is not the cogs aren't turning over as they were, with the property cycle having fallen. So I've just got a little less confidence around their shorter term earnings, and just the speed of pick up again in terms of deal flow from their customers, particularly offshore. So we've trimmed our position as accordingly, thankfully before the share price, mostly before the share price has really fallen away in the last 6 to 12 months. But it's specifically to your question, it's for the funds management arm of the property, not the REIT arm of the property market, which is the reason we own it.
Great. And very quickly, two questions. One is about LIC. Are you concerned about the increased competition? And the second question is, what do you see as the main risk to PSI insurance and the ability to continue to compound capital over the longer term? Just quick answers to those, because we do want to give people time to finish their afternoon's work.
So lifestyle communities, I guess what the question is referring to is Stockland are now fairly aggressively moving into the space of that independent living market in Victoria, which is only where lifestyle operates. We're not overly concerned. If anything, it increases the awareness of this alternative accommodation, and the opportunity set is enormous as people downsize and looking for a cheaper alternative as they enter those retirement years. So there's no shortage of demand. So not a problem at this stage. And then in terms of PSC or PSI, PSI is the ticker. Is the I think the question was around the risks of investing in that company. I mean,
the main risks to their ability to compound capital over the longer term.
Yeah, so probably the risk around all the insurance brokers is the premium cycle. So it's been a very, they call a hard premium cycle, courtesy of inflation, natural disasters, etc. And the underwriters or reinsurers, they are still looking to recoup losses from the past, not to mention expected losses into the future from a world where we have environmental concerns. So that will continue to lead to inflation in terms of premiums for insurance, which benefit all of those companies. So incredibly well managed business. They've got a lot of skin in the game. They own a lot of the business. Proven business model. Probably the one thing out of their control is that insurance cycle, but we're comfortable with that at the moment.
Great, thank you. I am actually going to squeeze in one more, 2 sentences on Propel Funerals. Could that be over-earning?
That's a very good question, and it is. I probably should have mentioned earlier. So they, and we allow for that, obviously, in our valuation, but it's very obvious the over-earning. What we're alluding to there is that the death rate did rise. Think of it from the perspective of through COVID, where people were locked down and nursing homes. I mean, perversely, elderly people weren't able to contract the influenza and pneumonia, etc. So there was, I guess, a period there where they didn't pass. Trying to word this in a way where it doesn't sound too morbid, but suffice to say that since then there's been a reversion, and so you saw an uptick last year in the death rate back to sort of well above long-term trend lines, and it's very well documented and tracked through regression analysis from the ABS as to what the expected death rate is and the growth of that death rate every year. So our modelling is simply taking the industry growth. And as I say, reverting that back to long-term trend lines, which will make it very difficult for the company to grow strongly this year. But then we expect into 25, 26 that they will see that continual growth of about 15% per annum, which is what we expect for this company.
Great, thank you very much. In the interest of time, I am going to wind up. So thanks to everyone for joining us. My overwhelming takeaway every time I listen to Steve or equally Ed present is a consistent process which is conservatively applied, basically a safe, I was going to say pair of hands, but in this case, 2 safe pairs of hands. Thank you to everyone who submitted questions. The questions really make the webinar, and today we had some great ones. We didn't get to all of them. There are a lot that we will respond to you directly. So thank you very much for submitting all those questions. We have another webinar coming up tomorrow. It's with Fred Pollock. He's the portfolio manager of the Pengana Private Equity Trust. I have seen that presentation. I can tell it's going to be a very interesting webinar. So if you haven't registered, I would urge you to do so. You can do so on our website, pengana.com. If you have any other questions, please get in touch. Thanks very much and enjoy your evening.